If you're planning to retire in about a year, then one of the biggest questions on your mind is probably, do I have enough saved? And that's exactly what we're going to cover in this video. I'm going to walk you through an example of someone who is just a year away from retirement, and I'm going to show you how the numbers work out. Now, keep this in mind. The example I'm going to use is based on someone who is 64 and turning 65 next year and retiring. But even if you're younger than that or older than that, or maybe still a few years away from retirement, the framework of what I'm going to talk about here today still applies. What certainly changes are some of the assumptions around Social Security and healthcare and how long your money is going to need to last. But the point here is that no matter whether retirement is 12 months away or still a few years out, this approach will help you to see what matters most and also where you stand. Now, the right way to do this starts with what your spending goals are. So let's just use an example of, let's say that you want to spend $8,000 per month after taxes in retirement. The next thing is to take a look at what your guaranteed income sources are. So just for the sake of simplicity here, I'm just going to assume your only source of guaranteed income is Social Security. But this could also be Social Security, a pension, it could be annuity income, it could even be rental property, right? Things like that that you know that you can count on. Let's say your Social Security benefit is $3,000. And again, you want $8,000 a month. So that would leave a gap of $5,000 per month or $60,000 per year that would then need to have to come from your portfolio. Now, keep in mind, again, if your need is higher than this, or if it's lower than this, maybe it's $4,000 a month is what you need to live on each month, or maybe you need $12,000 a month to live on. It doesn't matter. Whatever that number is, again, the framework here still is going to apply. The math shifts for sure, but the process that we're talking about is still the same. One quick note too on taxes is that the gross amount that you need to withdraw, this is going to depend upon whether your money is in pre-tax accounts, in Roth accounts, or taxable. It's also going to depend on how much of your Social Security ends up becoming taxable. So there's some little nuances here. One thing I'll kind of mention is that, keep in mind, if your only source of income is Social Security, you won't have to pay any federal tax. It's only other income that can make up to 85% of your Social Security benefits taxable. And if you choose to have taxes withheld from your Social Security, by the way, the IRS only lets you pick either 7%, 10%, 12%, or 22%. So it's not precise, which is why coordinating, which accounts you pull from and how you set up withholding, all of this matters. Another thing to keep in mind is that healthcare, that's another big piece. In this example, the person is retiring at 65 and going straight on to Medicare. But if you retire earlier, say at 60 or 62, for example, then, the ACA premiums can certainly be a major factor, and managing your taxable income becomes even more important to help qualify for subsidies. So let's say you're 64 right now and you're planning to retire at 65. That $8,000 lifestyle, in my example here, assuming, let's just say, a 3% inflation rate, that would mean that next year we would need $8,250 a month. Social Security at 65, let's just say it might be around $3,100 a month gross. If we assume some withholding, that would mean you'd have about $2,600 a month after taxes. So that would leave about $5,650 net per month, or roughly $6,650 gross, so before tax, that would then need to be covered from your portfolio, which is about $80,000 a year. These are estimated numbers, all of these here that I'm talking about today. The most important thing is just understanding the concept and as to how all this applies. So the question is, you need $80,000 a year from the portfolio. So how much do you need to have saved at retirement to do that? And so if we assume just a 4% withdrawal rate, which is quite conservative, you'd have to have $2 million saved, approximately. If we assume a 5% withdrawal rate, you'd have to have about 1.6 million. And if we assume a 6% withdrawal rate, you'd have to have about $1.3 million. Now, you don't need to have that exact balance today. with even a modest 5% growth rate, just as an example, if you have just, that 5% growth rate over the course of this next year, you'd need to have, slightly less than those figures right now to be on track. Now, here's the part that most rules of thumb miss. Retirees don't spend in a straight line. Most follow what we call the retirement spending smile, where, typically spending tends to be higher in the early years of retirement. And then it gets lower in the slow go years and then even lower in the no go years. But it sometimes ticks up later on with healthcare costs. And so because of this, this is just one reason why the old 4% rule, it really doesn't fit. It really assumes that you're going to spend the same amount every year adjusted for inflation over the course of perhaps a 30-year period. And personally, again, I think 4% is often very conservative, and it will often lead to underspending in retirement. Even Bill Bengen, who was the creator of the 4% rule, he's recently said that 4.7% is now more realistic. But I will also say that for many retirees, starting at 5% or even 6% withdrawal rate can make sense, especially if you're willing to make adjustments to spending. And so, that means that we monitor their portfolio over time. If markets are strong, you may have the permission then to actually increase spending, to get a pay increase. But if markets are rough, well, then you may have to trim back temporarily on the other side. And this is also why it's important to understand of your expenses. So in the example that we're using here is $8,000 a month. How much of that is you actually have to have that every single month because that's paying for, groceries and things like that? And then how much is purely discretionary? And that helps to give you an idea of how much flexibility that you can have with your spending there in retirement. Having this approach can help prevent that underspending in your healthiest years while also still protecting you long term. Now, another thing I need to touch on here, of course, is health and longevity, because this can play a huge role. If somebody's retiring at 55, they might need their money to last for maybe 30 or 40 years, especially if they're in good health now, maybe have good longevity in the family, right? But and so if this is the case, this can call for more caution, maybe a more conservative withdrawal rate in that type of scenario. Whereas somebody retiring at 70, who maybe they're not in such good health, they may only need their money to last for maybe only 10 years, maybe 15, 20, 25, something like this. So that's why it's always so unique to the individual. And so if you don't need your money to last as long, of course, that would mean we could have a higher withdrawal rate. The bottom line, I think, here is that there is no single right answer. It's not just about how much you have saved. It's also how long you need that money to last, and also how flexible you are with being willing to adjust your spending, and which types of accounts that you have that money in, and based on how it's taxed, right? So there's some different nuances, of course, that need to be considered. Another thing also, not to forget, is that later in retirement, you've got the RMDs, the required minimum distributions, which can then force withdrawals whether you need them or not, which is just another reason to make sure that you're thinking about your tax strategy ahead of time. So how much should you have saved, just 1 year away from retirement? Again, for someone wanting $8,000 a month net with a $3,000 coming from Social Security, the range is maybe somewhere in the $1.3 to $2 million mark, all depending upon your withdrawal rate and all the different factors that we talked about. But remember, these are just numbers on paper. The real key is making sure that you have a coordinated plan that adapts for taxes, for healthcare, for market swings, for lifestyle changes. It's all of these things. Imagine this for you, waking up on the first day of retirement, knowing that your income's mapped out, that your risks are covered, that you can focus on enjoying life and not just have to worry about, just building out spreadsheets and things like that. That's the kind of clarity that I help people with. That's what I do. If you'd like to explore more about how I help people and how I do it, there's a link below. Click on that and learn more. I'll see you in the next video.